I guess the speech from Christine Lagarde was quite outspoken for a Sintra speech because it really sets the tone for the discussion here. So what do you think about it? And do you agree with her, stressing the uncertainties?
I think it was a very good speech. It very much appreciated what has happened with inflation, that the disinflation process has been quite strong, and also explaining why we started our easing cycle in June, and also kind of very frankly setting out the environment in which we are going to take the further decisions. And uncertainty certainly is a big element there.
But how many rate cuts do you see for the remainder of the year? Because some people or some governors, I should say, are suggesting there's room for up to 2.
Well, the financial markets currently are pricing 1 to 2 cuts this year, and in my view, it is consistent with the baseline scenario that we have. Of course, we will be data dependent. We will every and each time when we take the decision, we will see what happens, not only with inflation, but also wider spectrum of data points. So don't be, misguided just by one data point. It's data dependent, but currently I would very much agree that the current market pricing seems quite reasonable.
We're seeing inflation, at least the recent inflation print, just heard it from Steve reading it out in the studio, coming back in the biggest market of the euro area in Germany, more than expected. So are there early signs that inflation is perhaps coming back faster than expected?
That would be in a way good news. Okay, and that would very much show that the disinflation process is somewhat quicker, and we would reach 2% target perhaps earlier than the second half of 25. But let's take some time and let's see all the data for euro area inflation and then see what happens. We know that for most of this year, at least our forecast, forecast that it's going to be moving by and large till late in the year sideways. It's going to be quite bumpy, some months up, some down. So let's be calm. Let's see what the data tells us where the economy is going. If the economy is weak, of course, that opens up more opportunities for rate cuts.
Yeah, and then let's look at the economic outlook, because also here we had actually disappointing leading indicators for a couple of economies in the euro area. Does that mean that might actually give you more room to cut?
If economy is weak and it weakens inflation, of course, then there is much more space to move, because we know that we are back to 2%. But looking at Europe, of course, the recent PMIs have been quite patchy. We've seen a bit stronger consumer side, but corporate side was somewhat weaker. Overall, we need more growth in Europe. We need more growth, and that, in my view, means that we need more structural reforms, more reforms that are pan-European. Because currently, when we look at the economy and reforms that are necessary across national borders, we look at them within the nation state. That fragments us, that makes growth smaller, that makes scale smaller. We need more of pan-European support for growth, single market and services, capital markets union, also defense spending, which would be much more aligned across the states.
How likely do you think we'll get that, given the push to the right, also on the European level, looking at the European election now, looking at the political risk in France? So is that just a wish, or is that reality?
I think this is, this is the thing to work on. And I think President Lagarde's speech yesterday was also pointing out to the risk of political uncertainty for growth and economies going forward. I think it simply sets the stage where the decisions need to be taken. Of course, it takes guts for politicians to do it, but that's their task.
But economic growth also needs cheaper financing costs. I know it's a very tricky path for you, setting the interest rate environment, but is there not perhaps a risk of over-engineering it by staying too high for too long?
We can always adjust both the pace and the size. we very clearly are on the downward path for the rates. And be sure, we will not linger with rates being too high unnecessarily long. Okay? We want to make sure that we return to 2%. Currently, the forecast says in the second half of 25, that will mean that we will have stayed above 2% target for 4 years, which is quite a long time for medium term. And I would certainly not like to see it being pushed into 26. Okay? So let's take it back to 2%. And that will be a foundation for further growth, for recovery in incomes. So with high inflation, with volatile inflation, and with risks perhaps at some point inflation rebounding, we cannot afford that.
How independent can you be in your policy setting from the United States? We have Jerome Powell here on the ground as well, so I guess the day's in for interesting discussions when it comes to these questions, right?
Of course, that's one of the topics to discuss, but our mandate is 2% inflation for the euro area. So we take a look at what happens here. Of course, what the Fed does affects the US economy and global economy, and we take that into account, but we take our decisions independently.
How confident are you about the transmission protection instrument the ECB has in place? Do we potentially need it?
Well, instrument is there. You know, if you need it, we would use it. But currently, I see no reason, to discuss using that instrument, because that is tailored for disorderly market reactions, which we don't see at the moment.